bring Gary Shilling in here right now. On bonds, you can see us here, 3.31%. What do you have to do? Stop at the food court or something?
Well, actually, they've got some great cut up carrots and peppers and good things like that.
Well, I'm glad you stopped there.
I mean, that's very healthy. Very helpful.
Shameless plug for the Bloomberg.
Yeah, it's almost as good as honey, Tom.
Well, that's almost as good as the bees and the honey. Let's look at chart 7, if we could here, Rex. This is the Shilling disinflation. I want to go back and remind people why we have you on the program. What was it like in 1980 to say, I'm sorry, there's going to be less inflation? You and Bill Poole were a little lonely, weren't you?
It was very lonely. As a matter of fact, I wrote my first book back then, and McGraw-Hill published it finally in 1983, and it was a bomb. Because even in 1983, 3 years after inflation had peaked, nobody believed it. It really was a very, very unfortunate.
Look at this chart, folks. This is the Federal Reserve 10-year yield. It's a yield we know. There's Paul Volcker over in the upper left corner when Bill Poole wrote in '78 his great paper. And down we go. John Taylor worries about an end to the great moderation. Do we have control of our monetary policy? Do we have control of the underlying theory that allows us to make good decisions?
No, I don't think so. I mean, monetary, first of all, policy in general tends to follow the parade, not lead it.
Right.
And, in a way that's good because we hire politicians and indirectly central bankers to react to problems, not to be a bunch of planning types. That's more like a dictatorship. And beyond that, they don't know what they ought to be doing ahead of time anyway. So
I want to spend most of the time today in the present. You've got a great factoid. Folks, it's the number of the day. Hey, Gary Shilling. I got to get my bow tie straight. The number here, 46% of $805 gajillion fiscal stimulus was saved. Matthew Shapiro at Michigan would go, you think? I mean, this is not a surprise, is it?
No, it isn't, because I think people are on a savings spree for the first time in 25 years. They need to save for their retirements. Supposed to our babies, they haven't. People have sucked all the money out of their houses with home equity loans, et cetera. So there's nothing left there to fund oversized spending. People are very much concerned about high unemployment.
Right.
And they don't really trust the stocks the way they did back in the 80s and 90s when they were going straight up. So you got a lot of reasons that people, I think, want to save. And so, hey, the government hands them a big wad of dough. They save about half of it.
We've got about a minute here. We want to have you back to talk more about your book, The Age of Deleveraging. What should an investor do now, given your GDP caution versus consensus?
Well, I think be careful. Stocks have got a lot of momentum behind them, and maybe the earnings will come through to justify them. But I think there is reason for caution. I wouldn't say we're in a frothy stage of the stock market, but it certainly has come a long way since March of '09. And you're getting to the point now, like commodities. I think commodities are clearly in a bubble. Stocks aren't there yet, but we could be if things keep up at this rate.
The book is The Age of Deleveraging. Gary Shilling. I want to bring up this chart. The bounce is over. This is sort of the meat of your new insight you've got out to your clients. Shilling, the bounce is over. Inventory to sales ratio. Okay, you look at it. It's like a tertiary thing. Why is this a big deal to you?
Well, because the inventory unwinding was really the spur to economic growth. In the first 7 quarters of expansion we've had so far, it accounted for about 60% of economic growth. Final sales, everything but inventories, were only about 40%. So, and I think it's over because inventory sales ratios have moved up lately, and I don't think that's by design.
Bring this chart up again. I want to walk through this chart here because this is great from Gary Shilling. You can see the inventory compared to sales goes down, 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 leaner inventories, and then we plunge. That's the shock, and there got little lines coming up there. We're coming back, aren't we?
Yeah, that's right. And as I say, I don't think that's voluntary. I don't think that's by design. So that says you're probably not going to get much more inventory building. So from here on, it's the rest of the economy. Now, I think a real key question here is what's going to happen to the consumer.
Yes.
Is a consumer satisfied with a saving rate now about 5.5%? When real wealth is still very depressed and debt is very high? I don't think so. I think the saving rate's going up into double digits. But that's a key assumption for this year, because to get strong growth this year, I think you almost have to have a consumer given up on the saving spree.
Yeah, Martin Feldstein at Harvard at AEA really talked this up as well, looking at final sales, real final sales, domestic final sales, another way of saying it. And the answer is there's a mystery of the consumer, and the dichotomy is Byron Wien with his pick saying 5% GDP, and Gary Shilling saying 2%, I believe.
Right.
I don't want to put words in your mouth here. What do the optimists have most wrong? Is it that consumer confidence?
I think it's got to be. I don't see how you get there, because consumer 70% of GDP, and if the consumer is not going to reduce that saving rate from here, I just don't see how you can get that 5% growth. You say, well, what else? Housing's way overburdened with inventories. Capital spending, you got a lot of excess capacity. Exports, a little bit better. We saw the numbers today, but that's not going to carry the ball. You look down state and local government. Hey, they're under real pressure. You were covering that earlier, and that's an absolute disaster. And the federal government, our estimates are that you have a fiscal drag, negative stimulus this year of about $100 billion.
Here's Capital Economics. Paul Dale's over the United Kingdom. He's on the edge of Byron Wien. U.S. trade data support 4%. Q4 GDP growth. We're beginning to see this, Gary. I mean, the consumers there, November's U.S. trade figures support their view that annualized GDP growth, it'll just creep up there. It's not that you've been proven wrong, because you've gotten a lot of different subsets right, but nevertheless, how do you push against the resiliency of the American spirit and American innovation?
Well, that's a very good point, Tom. And I've got to say, I've been through enough cycles to know that you look at the situation, you say, gosh, there's no way out of this. You go through the sectors, and somehow a little of this, a little of that, a little of that, and the thing kind of gets together. Now, the real question is, are we in a typical cycle? Is this a typical recovery, or do you have some overarching realities? And I think the overarching reality is a deleveraging that's going on after 3 decades of leveraging up for consumers and 4 for the financial sector.
Rex, bring up the dreaded first chart that we started the show with. I got to get my Rex, you're supposed to tell me if my bow tie isn't straight. Come on. Here it is. Here's Eichengreen earlier, Gary Shilling. Barry Eichengreen, the dollar will have rivals. Are you concerned that we could lose the reserve status of the U.S. dollar?
Oh, sure, but I don't think that's something within 10 years, Tom. In other words, you say, okay, they're starting to loosen up a little bit on the yuan, the Chinese, but boy, that's still pretty much a controlled economy. The euro, hey, they tried to jam together the Teutonic North with the Club Med South, and they got a first-class mess there. That's not a reserve currency.
Yeah, I traveled to Teutonic once for my 2-week vacation. That was Club Med. Gary Shilling, thanks so much. We're going to leave it there. The agency leveraging.